The recent dynamics in the economy, punctuated by an over 25 shillings depreciation since January and now the increasing cost of borrowing, have had the biggest hit on the business community. Traders, however, feel government policy is partly to blame, especially in its failure to synchronize activities on different departments and economic policy implementation agencies.
What has been happening is that, Bank of Uganda has been trying its side to work on the monetary policy, but government on the other side of the fiscal policy has not been so helpful. We see, according to the reports which we are getting, that the government is out to increase its expenditure by opening up new constituencies, by opening up new districts, and even creating new municipalities.
And that's not all. The move by the government to ban the export of some key products, as it did, is a luxury that traders say government could not afford.
Kenyans will be producing for this market both tobacco, they will be producing for this market even the kavera, and which is very dangerous. Kenya has over 200 companies, about 120 companies which are making kavera, but in Uganda we have about 15, and again we are blocking that area. Meaning that at the end of the day we are going to encourage the smugglers to take over even that small market. Already we are seeing a lot of resistance which is being put against our sugar which we want to export to Kenya. But at the same time, even these areas where we have been efficient, where we have been doing well in tobacco, again we are stopping them.
Over a year ago, the president banned the export of raw minerals, a decision which he lifted last month. In the same breath, Uganda is currently living with a self-imposed ban of fruits and vegetables to the European Union market over quality issues. All these, according to traders, have cumulatively undermined the country's ability to rake in enough dollars to stabilize the shilling. So for the issues of the traders to be successfully dealt with, they believe the solution is for the government to get its priorities in check.
The government really needs to redirect resources more towards sectors that are going to create wealth, sectors that are going to drive production, especially for export, for us to be able to fetch that foreign exchange that we are looking for. So that decision, the fundamental decision to cut back on government spending, reckless spending, I must say, must be taken by none else other than the president.
Uganda recorded a trade deficit of $273 million in June of 2015. The country's main trading partner is Kenya, with 15% of imports and 10% of exports. Ingrid Nantege, NTV Business.